so let's ask the question, why do you like IUL versus whole life or VUL? Like what situations you highlighted that if somebody's younger, VUL might be a good option, but why whole life versus IUL potentially?
Well, I've written one whole life policy in my life. I think that was back when I started with MetLife Financial. It was a funeral policy. So I don't, as a matter of personal preference, I don't write whole life. There's a couple of reasons why I don't use whole life. Generally, when I'm using a cash value life insurance policy, the cash value accumulation is pretty important. So I want to be able to get, I want to be able to get more rate of return than I'm accustomed to getting in a whole life account. And then somewhere down the road, I'm looking to take that money out and spend it on my lifestyle at a period in time when tax rates are likely to be higher than they are today. And that's when loan provisions become very, very important. I was weaned on the idea that when you take money out, they're going to charge you a loan interest rate. You're not taking a loan from yourself. You're taking a loan from the life insurance company. They're loaning you money and they're charging you a stated rate of interest. That's a very real rate of interest. Okay.
Mm-hmm.
And then on the other hand, so that's what happens on one side of the ledger. On the other hand, they're opening up what I call a loan collateral account. They're taking money out of your cash value. They're putting it in that loan collateral account and they're crediting a stated rate of interest to that account. And there's some companies out there that credit you exactly what they charge you. So they might charge you 3.5%, but they'll credit you back 3.5%. So the net cost of borrowing is actually zero. And there's a lot of companies, not a lot, but some companies guarantee that in the contract so that when you ask for the money, you get the money. Your cash value goes down by that amount. You don't pay tax, and it doesn't show up on your tax return from a tax perspective, and you get to spend that money tax free. Whole life policies don't have that luxury. There is no guarantee that when you take that money out, it's going to be a zero cost loan. It could be in a given year if what they're charging, what they're crediting you back is the same amount, but there's no guarantee that's going to happen. And even if there were a 1 or 2% or even 3% net cost of borrowing over time, every year that you don't pay that loan back, they're going to subtract that loan interest out of your cash value. And even a 1%, I've done the math on this. We got spreadsheets that show it. Even a 1% net loan provision could bankrupt you 11 years faster. A 2% loan provision could bankrupt you 18 years faster. So when it comes to the type of planning that we do, whole life just isn't an option. Number one, the rate of return just isn't robust enough. The reduction in rate of return you experience in whole life can completely neutralize the benefit that justified doing the life insurance to begin with. And then the cost of borrowing, I think that is literally the most important provision in the entire contract. And if it's not guaranteed and it's not zero, you're going to be paying interest over time. And so I think people that position whole life that say you're going to be able to build money up and then take money out tax-free down the road, and they don't address the 800-pound gorilla in the room, which is the loan provision, I think that that's a little bit misleading. And so I think that a contract that has a guaranteed 0% loan that can get safe and productive growth rates over time can accomplish some really interesting things.
Yeah, it's interesting. There's not a local company. I will say this. It is a company who's headquartered in a place in which we both used to mutually live.
Yes.
Their policies, when I've seen them, I have several clients I've found that they have sold policies to in the past, and when they went to take a loan in 2022 and even in 2023, because things were slowing down, market's down. So hey, if the market's down and you need money, borrow from your policy, right? Don't pull money out of the market was the theory. 8.75% was the loan interest rate on those. And but the reps would say, well, these policies with dividends, they'll do 8% a year. So steady, and it's like, well, first off, you're upside down 75 basis points on the loan. And so their solution was, well, you can go and pledge this policy and just get a line of credit at a bank really easy. And the problem is then you're on prime, right? The prime credit index, which right now is 8.5. So you're still upside down. And if you're, depending on that institution would maybe pull your credit. You could be like prime plus half. Now you're at 9.25. You're still upside down. There's not really a way in which that's favorable. And so one of the things that I've noticed is that oftentimes on whole life, when somebody gets an illustration, I've never seen a whole life illustration that it shows them how money coming out of the policy as loans works on the back end, right? They say, oh, it's a feature, it can happen. But it never shows how that really works out. Hey, what if you start taking loans at 65? How long can you do that before this policy accidentally blows up? That's really a really good call out. And so how do you maybe pair that with the risk of the IUL, right? So what people that sell whole life will talk about is, hey, there's no guarantees in the return. There's no guarantees in the cost. And so maybe you do okay with the indexes, but you could goose egg. You can get no return, still have the cost. They can change your participation rate on the crediting. They can change your cap on the crediting. And so, because of those reasons, they feel whole life is a superior product. How does that, with the planning that you're trying to do, accumulate cash and then be able to take it back out in your lifetime for funding lifestyle, how does that kind of work out?
Well, whatever road you take in life is fraught with peril. I mean, if you put money in whole life and interest rates remain historically low, you're not going to get a great return on your money. There's going to be an opportunity cost associated with that low return. Literally anything you do has potential opportunity costs, potentially fraught with peril. There's no guarantees in life. What are you getting in exchange for that increased risk with the IUL? I think you're getting two things. You're getting potential for about 1.5% to 2% more return over time. I've talked to lots of actuaries. I said, level with me. What rate of return can I expect over time? We know interest rates are going to ebb and flow over time. What do you think is a realistic, and these are people that, they're actuaries, they're not salesmen. They're just telling me what they think based on the history of the program or where they see things going over time and Monte Carlo scenarios and things like this. What rate of return do you think the IUL can get over time above and beyond what I might be able to get in a whole life policy? And their consistent response is 1.5% to 2% more over time. Okay. So I'm going to get I believe if what the actuaries are saying is true, that I can get a better rate of return over time. And the other thing that, like I said before, that I'm going to get in the IUL that I'm not going to get in whole life is I'm going to get the possibility of getting a guaranteed 0% loan, which makes that entire problem that we've been discussing completely go away. This problem that says that if there's a net cost to borrow, that's going to weigh on your cash value, drag your cash value down over time, and could bankrupt your policy years in advance of when you ever thought possible, which means you're going to get a phantom tax bill from the IRS, and you would have been better off never having done the policy to begin with. So those are two things that I think the IUL gives me: greater return and a possibility of getting the money out. I always make this distinction. All life insurance policies allow you to take the money out tax-free by way of that loan, but you need the distribution to be tax-free and cost-free. Whole life is going to give you a tax-free distribution by way of that loan, but it's not going to be cost-free. It's never going to be cost-free. Okay, there's always going to be a net cost to borrow. Folks, my upcoming book, The Guru Gap: How America's Financial Gurus Are Leading You Astray and How to Get Back on Track, is now available for pre-order on Amazon. Take the opportunity to order your copy today. By the way, in the next 10 years, I'm looking to put 100,000 Americans on the road to the 0% tax bracket. If you would like some help implementing a balanced, comprehensive approach to tax-free retirement that shields you from the impact of higher taxes, head on over to davemcknight.com and click on the Connect with an Advisor button. I'm happy to refer you to an advisor in the Power Zero network that has been trained, vetted, and qualified personally by me. If you're a financial professional and want to learn how to become a certified Power Zero advisor, head over to powerzero.com and opt into my free video series. And if you have any comments or questions, feel free to drop them into the comment section below. I'll respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.